Welcome to Investor Web, the go-to channel for all your investment queries and financial insights. Here at Investor Web, we're dedicated to demystifying the world of finance, breaking down complex topics into manageable, understandable pieces. Whether you're a seasoned investor or just starting out, we're here to provide you with the knowledge and tools you need to navigate the financial markets with confidence. Our aim is to simplify the often complicated world of finance, making it accessible to all. From investment strategies to understanding global financial markets, we're committed to fostering financial literacy and helping you make informed decisions about your financial future. Today, we're diving into a topic that's fundamental to our global economy, yet often misunderstood: the problem with fiat currencies. So sit back, relax, and let's explore this intriguing topic together. Stay tuned with Investor Web, where we make the complex world of finance simple and understandable. In today's video, we're going to delve into a topic that impacts us all: the problem with fiat currencies. Fiat currencies, a term that might seem alien to some, are actually an integral part of our everyday lives. Yes, that's right. The dollar bill, the pound sterling, the euro, or whichever currency you have in your wallet right now, is a fiat currency. A fiat currency is any legal tender whose value is backed by the government that issued it, but not by a physical commodity like gold or silver. The value of fiat money is derived from the relationship between supply and demand and the stability of the issuing government, rather than the worth of a commodity backing it. In the global economy, fiat currencies are the most commonly used type of currency, forming the backbone of all financial transactions. But as common and as crucial as they are, they're not without their problems. So buckle up as we unravel the complexities of fiat currencies. But first, what exactly is a fiat currency? Let's break it down. In the simplest terms, fiat currency is money. But it's a specific type of money, one that gets its value not from a physical commodity like gold or silver, but from the trust and confidence we place in the government that issues it. Fiat currencies like the pound, the euro, or the dollar are legal tender, meaning the government has declared them to be an acceptable form of payment. So how does this work? Imagine you're holding a £10 note. That piece of paper in itself isn't worth £10. It's the promise behind it, the faith you have that you can exchange it for goods or services worth £10 that gives it value. That's the essence of a fiat currency. Now you might be wondering, why would a government choose to use fiat currency? Well, one of the main reasons is control. With a fiat currency, a government can use monetary policy to influence the economy. It can increase or decrease the money supply to manage inflation, stimulate economic growth, or tackle unemployment. In essence, it gives the government a powerful tool to manage the economy. However, this power comes with a key responsibility. The government must maintain the trust of its people. If that trust is lost, the value of the fiat currency can plummet, leading to inflation or even hyperinflation. We've seen this happen in history, where countries have printed money recklessly, leading to devastating economic crises. Fiat currencies are also characterized by their lack of intrinsic value. Unlike gold or silver, which have industrial uses, fiat money has value only because we believe it does. This characteristic makes fiat currencies both flexible and vulnerable. So, in a nutshell, fiat currencies are a type of money that derives its value from government regulation and law. They are a cornerstone of modern economies, playing a crucial role in facilitating trade and economic growth. Now that we understand what fiat currencies are, let's explore their drawbacks. Fiat currencies, although widely used, have certain inherent problems. Just like any system, they are not without their share of challenges. To truly comprehend the complexity of these issues, we'll delve into the three main problems associated with fiat currencies: inflation, devaluation, and the potential for economic instability. First up, inflation. This is a term you often hear in financial news or economic reports. But what does it really mean? In simple terms, inflation is the rate at which the general level of prices for goods and services is rising. Now you might be wondering, what's the big deal about a small increase in prices? Here's the catch: when prices rise, each unit of currency buys fewer goods and services. This is especially problematic for those living on fixed incomes like retirees, because their purchasing power is continuously eroding. Next, let's talk about devaluation. This is a deliberate downward adjustment to the value of a country's currency relative to another currency, group of currencies, or standard. Governments often resort to devaluation to make their exports more competitive in global markets. However, a devalued currency can lead to import inflation, which hurts domestic consumers as imported goods become more expensive, pushing up the cost of living. Finally, we come to the potential for economic instability. Fiat currencies are highly susceptible to economic downturns. When confidence in a country's economy wanes, the value of its currency can plummet, leading to financial crises. A classic example of this is the Great Recession of 2008. Moreover, because fiat currency is not backed by a physical commodity, its value is largely based on the government's promise to pay, a promise that can be broken in times of crisis. This lack of tangible backing heightens the risk of hyperinflation, a situation where the prices of goods and services escalate rapidly as a currency loses its value. To add another layer of complexity, these problems are often interconnected. For instance, a country trying to combat inflation may resort to devaluation, which in turn can lead to economic instability. It's a bit like playing a game of economic whack-a-mole, where solving one problem often gives rise to another. In essence, the problems associated with fiat currencies are not just theoretical concerns, but real issues that can have far-reaching implications. They can erode personal wealth, destabilize economies, and even trigger global financial crises. These problems pose significant challenges to economies worldwide, and it's important to understand their implications. As we navigate the world of finance and investment, understanding these issues helps us make informed decisions and perhaps even find ways to mitigate these risks. The problems with fiat currencies aren't just theoretical, they have real-world implications. Let's delve into how these problems impact our economy, businesses, and individuals. It's like a ripple effect where a single pebble, in this case fiat currency, can cause waves throughout the entire pond of our global economy. Inflation is one of the major implications. As governments print more money, the value of our currency decreases. Imagine you're holding a $100 bill today. Due to inflation in 10 years, that bill might not have the same buying power. This decrease in value can lead to a higher cost of living, making it more difficult for individuals to meet their basic needs. Let's look at a real-world example, the hyperinflation in Zimbabwe in the late 2000s. The government printed so much money that at one point a loaf of bread cost a whopping 100 billion Zimbabwean dollars. This situation led to economic instability and hardship for its citizens. Then there's the issue of economic bubbles. When there's too much money in circulation, it can lead to an overvaluation of assets, creating a bubble. Remember the housing bubble of 2008? When it burst, it led to a global financial crisis, affecting businesses and individuals alike. And let's not forget about debt. Governments often resort to printing more money to pay off their debts. But this can lead to increased inflation and more debt, creating a vicious cycle that's hard to break. Moreover, fiat currencies are susceptible to currency manipulation. Governments can devalue their currency to boost exports, but this can lead to trade wars and global economic instability. Finally, the reliance on fiat currencies can create economic disparities. Wealthy individuals and corporations can benefit from these systems at the expense of the average citizen, leading to increased income inequality. Understanding these implications can help us make more informed financial decisions. The ripple effects of fiat currency problems are far-reaching. By being aware of these issues, we can better navigate the financial world and protect our economic well-being. That brings us to the end of our journey exploring the problems with fiat currencies. We've delved into the concept of fiat money, shedding light on its inherent issues, from inflation risks to government control. We've also touched on the potential implications of these problems, which can extend far beyond our pockets and into the broader economy. It's crucial to understand these issues, particularly for those involved in the world of finance and investment. Being aware of the pitfalls of fiat currencies can inform your decisions, helping to mitigate potential risks and exploit opportunities. In this ever-changing financial landscape, knowledge truly is power. So keep learning, keep questioning, and keep investing wisely. And remember, this is just the tip of the iceberg. There's a vast world of finance out there, waiting to be explored. Thank you for joining us on InvestorWeb. Don't forget to subscribe for more insights into the world of finance and investment.